This is Josh Jelinski, the financial quarterback, coming to you live. And we're with one of our all-time favorite guests of WOR, back from his days on the Dolans.
Right.
Which people brought that up the last time. I almost got crucified, Ed, because I brought up the Dolans. And I guess Ken passed away.
Oh, I didn't know that.
So I didn't know that either. And then sadly, Ken passed away from cancer about 3 years ago.
Oh, yeah. It's been a long time. You know, I did their show for years, like 20 years ago. They were fantastic. Oh, I'm sorry to hear that.
Yeah. And Daria is doing well. And Scott Lakefield, who's the assistant.
Oh, right. Scott. Yeah.
For WR told me that. But we actually, the last time we had you, we mentioned the Dolans, and I got all these emails saying, they
did a great job for people. They helped probably millions of people over their career.
Yeah, they were the predecessor to me. So
yeah,
without them, we'd be nothing. And we certainly respect their legacy. And also back to when they brought you on.
Oh, yeah. I used to go up to the studio on Broadway, WOR.
Yeah, those were the days, that studio. That was a great studio. So we have Ed Slott, New York Times bestselling author. For our listeners who don't know who you are, and viewers now on our YouTube,
I'm listening.
Our budding YouTube program, describe for our listeners your background as a CPA and what brought you to the IRA distribution landscape.
Oh, well, that's easy. I was a CPA. I'm still a CPA, but back, I'd say over 30, 40 years ago, it was like the average CPA, preparing taxes for clients, business, and individuals. And little by little, clients started retiring. That was unusual back then. Now we're seeing the big wave. And I noticed them taking money out of 401ks, which were kind of new then. Remember, before I'd say 1980 or so, there was no such thing. People used to get something called, now your listeners may not know this, they were called pensions. Pensions. These were checks they gave people for nothing, for just sitting home. And companies over time said, what's the deal with this? And somebody came up to them and said, hey, Mr. Corporation, how would you like to shift both the risk and the responsibility for saving for retirement from you, Mr. Corporation, to your employees? Let them have the problems. He said, where do I sign? That was the 401k. So most of the pensions went away and people started building up their own accounts. So this, I guess, started maybe late 70s or early 80s, and people started taking money out of those accounts probably a few years later. And as I was doing returns, I realized people were making all kinds of mistakes. The money that was coming out was taxable at ordinary rates out of a 401k. And many of them made distribution errors that caused taxes and even penalties because they didn't know things. And here I was after the fact. Remember, this is in tax time the next year for the prior year. And I would look at that and say, well, what'd you do? You know what you should have done? And I realized there was this big void. They weren't getting advice on the distributions. There was plenty of advice, just like there is now, on investing, but not for the tax planning on getting that money out. And it hit me, this is no place to be. It was like I was the bad messenger every year at tax time. Oh, you know what you should have done? So it hit me to be more proactive. Preparing taxes, and most of my colleagues still do it as CPAs. CPAs that prepare taxes are really just history teachers. They tell you what already happened, but that's too late. And I realized I had to be proactive and do planning so these things wouldn't happen and people could navigate the rules, which were kind of new, of getting the money out. It's still the most complex area of the tax law, and you have to know it when your time comes in retirement. And we're seeing a whole new generation now, all the baby boomers coming out either in or near retirement, subject to required minimum distributions and a bunch of other rollover type rules, Roth conversions, and there really still isn't a lot of advice. So I realized back then, this going back over 30 years, that this would be something that could really help people. So I started developing an expertise in what became actually a new genre of planning, distribution planning, getting the money out. Yet it wasn't a big deal then because most people didn't understand there was a problem until it was a problem. And that's where we are now. So I started actually going out and doing these estate planning seminars and tax planning seminars to educate clients and get new clients and help them with the distribution planning. But my career took a little unexpected turn when I noticed, besides consumers, financial advisors would show up at my seminars. And I knew who they were. They were the only ones in suits, obviously. And they would sit in the back of the room and wonder, what is this guy up to? I never heard of such a thing. And then when they realized I don't sell any financial products, any stocks, bonds, funds, I'm just a tax advisor, still am.
You weren't a threat to them.
Right. And they said, hey, can you do these seminars for me and my clients? And then this went on. And all of a sudden, now we have a full production company. We've had that for over 20 years. We run our own mega programs. You've probably seen ads for them. Our 2-day programs, our elite programs, our master's level training for advisors and consumers. So that's what we've been doing.
One time I flew out to your Vegas one. It was incredible.
Yeah, and we train advisors. And most advisors still don't have the training they need. And the money is just flooding out of these accounts, especially now after COVID and early terminations and retirements and the stock market taking off. So you have a flood of money coming out, and most people still are unprepared for the tax planning on the way out.
Yeah, a lot of people are familiar with accumulating the money,
right,
growing it, but not distributing it. And I love you have your book plastered all along your
book.
Oh,
how'd that get there? That was supposed to be subliminal.
You know, it was subliminal, but then I realized this is your favorite book, that the best book you ever wrote. In fact, all over the years I would have you on and said, oh, in the Retirement Savings Timebomb and How to Diffuse It. The old book, what was the old book title?
Same time. Well, this is the same title, except, it's funny, when I was talking with the publisher, because this is brand new. This just came out in 2021 this year.
Well, the old one, wasn't it called Retirement Savings Timebomb?
The old one was called the Retirement Savings Timebomb and How to Diffuse It. So my publisher said, after all these law changes, this would be a perfect time to put out a new edition. And he said, what do you want to call it? And I said, let me think about it, because they're going to put it out as a new book. And I said, you know what? Let's just add the word new. And they said, oh, I love that. So it's called The New Retirement Savings Timebomb. And they liked it. So that's it. And that's all right up to date for 2021. It has the Secure Act, the CARES Act, everything you need to know. And it's loaded. It's over 400 pages.
And this is from who? USA Today and other sources, called the best source for IRA advice. You're one of your best programs, I think, of all time, your PBS. I remember the first time we were vacationing, and my wife goes, what are you listening to? It was like, 1 o'clock in the morning.
Yeah, everybody says that. Ed, I couldn't sleep and I was flipping the channels, and there you are.
No, but I was up. I was up, with bated breath, awaiting every word. And my wife's like, what are you watching at 1 o'clock in the morning? Turn it off. And I said, Ed Slott. She said, what? And she knew of you. And you were instrumental to my career because I started in the business in around 2004. And I was reading about 401ks. And there was a book, The 401k Hoax. Yeah. And then there was another gentleman, Bob Castellone, he and you were the only two people talking about the IRA time bomb and how to diffuse it. So I'm so glad you have my favorite book of yours, freshly updated.
Oh, yeah.
I want to talk about the Bill Buckner story.
Oh, yeah, it's still in there. I softened it because at the time I wrote it, it was kind of a fresh wound to the Boston Red Sox.
Yeah, nobody knows Bill Buckner anymore. Yeah.
Yeah, but after they finally won a World Series, I don't know if you know, before he died, they brought him back for an opening day first pitch, and he got a standing ovation. I think it went on for several minutes at Fenway Park.
Wow. So we'll take a short break, and when we return, we'll be back with one of our favorite guests of all time, Ed Slott, the new Retirement Savings Time Bomb and How to Diffuse It. You can get that book by going to Amazon or going to IRAhelp.com, which is one of my favorite resources on all things IRAs. Where do you like people to buy the book? You have
Wherever they can get, just type in my name and the book will come. It comes up in all different places. I obviously get it on Amazon. You can go to our site, but I like to spread it around. So wherever you're comfortable getting it.
Okay, great.
I mean, there's got to be an alternative to Amazon is what I'm saying.
Yeah. Or you can call us 888-988-JOSH, and we will give you the book at no charge when you schedule and keep your no obligation review. So we'll be back after these messages with Ed Slott. And we're back. This is Josh Jelinski, the financial quarterback. Don't touch that dial. So Ed, we were talking about the difference between the accumulation distribution phase. I want to talk about that a little bit more because I think people are still, they don't get it. And I want to talk to you about my origin of how I found out about you somewhere around the 2000s. And I was shocked. Now realize I was a 22, 23-year-old kid. If I could have been your Jeff Levine, 10, 15,
yeah, right.
20 years ago, I would have called you up, but Jeff's a little bit younger than I am. So mind you, I was 22 going around telling people with millions of dollars in their IRAs. Mind you, I had no money growing up. I was not from a wealthy home or background. And I was telling people, your IRA is a big tax time bomb. And I would have people go, oh, you're fear mongering. Now it's common knowledge. People understand Roths. They understand tax deferral as a problem. But back then, you were one of maybe 1, 2, or 3 voices at the most. I mean, just off of my memory, it was you. There was some guy who wrote a book on the 401k dilemma or the 401k hoax. I forget what, but it was, and then there was Bob Castellone. You were it. And, but thankfully, you were one of the first people I read. And so same with Bob. And I was amazed at how other advisors weren't embracing it. Like for me, it was just like truth. As you always
well, it was
say,
for me too. It was an epiphany. But back 30 years ago, I said, this money's going to come out at some point, and people are going to need to be prepared for the taxes.
And it's like the Willie Sutton story. Do you want to tell that to our listeners who don't remember it?
I'm trying to. Oh yeah. Willie Sutton. It was the bank robber. Right, the bank robber. And they asked him, "Why did you rob the bank?" And he said, "Because that's where the money is." That's exactly how Congress looks at your IRA and 401k as a gold mine for them, not for you.
And to me, that always made so much sense. But so this was, I don't know, 04, 05, 06. I was going around telling people, hey, you have a problem. Now it's like, oh, duh, but back then it was, people would look at you like you had 2, 3 heads.
It still hasn't sunk in for most people. And I think what's happened over the last 5 or 6 years, especially now with, like I said before, with the COVID and early enforced retirements and a big stock market buildup, we've reached what I call crossover point, where many of the consumers, people coming out of 401ks, know more than their financial advisors because it's their money. And they realize, hey, I've got 300,000, 500,000, $1 million. How do I get this out without losing half of it to taxes? And most financial advisors can help you make money. But when it comes to IRAs and 401ks, it's what you keep that counts after taxes. If you give it all away to taxes, what have you done? You built a savings account for Uncle Sam. And I don't know if you know this, he's not even your real uncle.
You know what? I think my son, Billy, loves you, Ed. In every show, for some reason, whenever you're on, Billy comes running. A couple times ago, we had you on. We were at a beach house in Florida. Now we're in Cape May. And guess who's coming to say hello?
Oh, boy. Now, that's what I call a beneficiary.
And did you hear him? He was so quiet. He's just listening. So Billy can be the CPA of the family.
Yeah, yeah.
And he's such a good little boy. So, okay. So sons, you want to take him? And my other boys are also looking.
Now there is a good candidate for a Roth IRA.
Exactly. So we'll talk about, what should people do with their kids and grandkids? But first, talk about the accumulation versus distribution.
Yeah, well, you call yourself the financial quarterback. So I'll give you a football analogy, which I use in the book. I think in the book I used a golf analogy, the front nine and the back nine. But I like the football analogy better. And since you're a quarterback, I got to use that one. Just like a football game has two halves, the first half and the second half. There's a saying in football, the score at halftime is irrelevant. Give me the score at the end of the game, and then I'll tell you who won. So lots of people play the first half where they work, build, save, and invest for their retirement. And then they come out at halftime and said, look, we've got all the money we ever will need for retirement. They pat themselves on the back, they go into the locker room, and they think they're done. Meanwhile, IRS comes out for the third and fourth quarter. They're playing nobody, so they win. You have to play in the second half of the game is protecting it, paying it out, and keeping it and managing the taxes to keep more of your hard-earned money.
Yeah, and it's so true. I also we probably have golf listeners and viewers as well. Use your golf analogy, because I think your analogies, your stories bring the point home. But too many people, they just do their 401k mindlessly. And
well, it's the same thing with golf. It's the front nine is accumulating, building. That's a 30, 40 years you work. But it's the back nine where the game is won or lost when you're taking it out. So it's the back nine or the second half of the football game. That's the distribution phase. That's the key to all of this. That's what will determine how much you keep and how much goes to the government. You want to keep more and pay less.
No, exactly. So what other problems do you see on the horizon?
I see big, heavy taxes. Matter of fact, the Retirement Savings Timebomb, which is what I call my new book, the new Retirement Savings Timebomb. It's new because there are new and even more severe threats to your retirement savings, due for several factors. Changes in the tax law, proposed changes that may come next year with higher rates, and a bulging stock market. So the more money, everybody likes to see their IRA values. They probably look every day, oh, the market's up again. I was just reading an article about the Gen Z and the millennials. A lot of them don't realize that the market could go down. It's never gone down, and it just goes up since they've noticed it. But all this buildup, it's also a debt building for Uncle Sam, for the government. If you have a pre-tax account, you might like to see that buildup, but you might not like to know that a lot of that is going right back to the government. In other words, you have a partner. Think about this. How would you like to have a joint account with the IRS, which is exactly what an IRA is? You're partners. So the point on how to diffuse this retirement savings time bomb, and that's what the time bomb is, the tax building, compounding, snowballing in your IRAs and 401ks. That's the retirement savings tax time bomb. It's a ticking tax time bomb. Say that 3 times fast. That's what it is.
And that's tax time bomb. That's
That's what you have to address. And every day that goes by and you see the market go up and you think that's great, that's more money for the government. So it behooves you to follow some of the steps. I give you 5 steps in here to move your money from accounts, I like to say, that are forever taxed to accounts that are never taxed. In other words, you want to move it to tax-free territory through things like Roth IRAs, even life insurance. I have a whole chapter here on life insurance. I don't even sell life insurance, but because of the tax law changes and the way Congress made IRAs a very poor wealth transfer and estate planning vehicle by eliminating most of the benefits to beneficiaries through eliminating the stretch IRA. It's really been downgraded as a wealth transfer vehicle, and life insurance has been upgraded. So is Roth IRAs. And now the minute you get your money in those tax-free vehicles, then all the compounding, then you want to look at your statement and say, wow, now I keep 100% of it. That's when you see a retirement account grow.
Now let's talk about that. First, go a little bit into Roths and how Roths can be used, and then we'll have a segment later on about life insurance. Go ahead and talk about Roths.
Well, Roth, I'm a big Roth fan. As I said before, I'm a CPA. I don't sell stocks, bonds, funds, insurance, annuities, none of that. So everything I give you is objective, unbiased. I do have one bias, though, against taxes. That's my bias. I do everything to help you keep more of your hard-earned money, like anybody would. It's just most people don't. And most people can't find financial advisors that can do the whole job, play both halves of the game. They can help you in the first half, most of them, but not in the second half, because it requires specialized knowledge in the tax rules. They're very complex rules. Not only are the rules complex, but they're unforgiving. There's not a lot of second chances. For example, a Roth conversion. Once you convert, that's it. There's no do-overs. That law was changed a couple of years ago. Now, a Roth, I wouldn't say to not do a Roth conversion because you have to pay tax up front and you can't undo it. But it is a way to move money from forever tax to never tax. Now, there's a cost for that. And that's where people get hung up. They say, why should I pay taxes before I have to? In fact, a lot of my CPA colleagues don't like the idea of paying taxes before.
A lot of CPAs hate that.
Yeah, because you got to understand, we were hardwired from the first day in accounting school in college, never, ever pay a tax before you have to. Always defer, defer, defer. It banged into your head, put it off. But over the years, once Roth came out, I became a recovering accountant. So I see the big picture. I look long term. It pays to pay taxes if you can get the money out, especially now at today's rock bottom, historically low tax rates. That's the whole game here. It's really one big game of what I call tax rate arbitrage, playing the tax rates. The key to all good tax planning is to always pay taxes at the lowest rates, which may be right now. If you can get that money out now and into a Roth IRA where it grows tax-free, if tax rates go up, you'll do better because you keep all of that money. In fact, once tax rates go up, anything that's in a tax-free account becomes immediately more valuable because it will never be eroded by future higher taxes. In fact, your money is worth more when it's in a Roth or in a tax-free vehicle like life insurance, because all the gains go right to you without Uncle Sam in between. And that's because you paid for that up front. You get something for your money. People think they just lose money up front. But remember, if you do nothing, this account is going to grow and be taxed later, probably on a higher balance at a higher future rate, leaving you less when you'll need it the most in retirement.
And when we return from the next break, I'll ask Ed about the recent ProPublica studies talking about Peter Thiel's mega Roth, and also Warren Buffett now has a mega Roth. So we'll talk about that when we return. But first, folks, call us at 888-988-JOSH for the new Retirement Savings Timebomb. That will be my free gift for you when you schedule and keep your no obligation 45-minute ultimate financial game plan for retirement. Or you can check out Ed's website, IRAhelp.com, or buy the new Retirement Savings Timebomb wherever books are sold. It's probably one of my top 5 financial books of all time. It's up there with, Rich Dad, Poor Dad, and all those other ones. That's more of a mindset book, but this is tactical. A lot of the books on finance are about your mindset, and that's very nice, but there comes to be a beauty in the tactical. Meaning you have an IRA, you have a Roth, you have life insurance. How do they work together? That's why you should get the book, the new Retirement Savings Timebomb from Ed. You may have seen him on PBS or read him. He's always featured all over USA Today, Wall Street Journal, financial news publications, investment news. So call us now, 888-988-JOSH. We'll be back to get Ed's latest take on the ProPublica. It was really kind of a hit piece. Not really a fan of the article, but it did reveal some things about Warren Buffett's Roth and Peter Thiel's Roth. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial.
The preceding program was sponsored by the Jelinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.